All right, good evening and welcome to tonight's webinar, How to Develop a Winning Trading Strategy, not a whining trading strategy. Hopefully you caught that. Here's an overview of what we're going to do. And let me first introduce myself. My name is Tyler Bollhorn. I'm the founder of Stockscores. I'm a professional trader, been trading for 27 years. And primarily these days, I am an algorithmic trader, which means I trade by rules. I don't trade on gut feel or opinion or research. I just trade rules, and that's something we'll get into a little bit tonight. But here's a quick overview of what we're going to do this evening. First of all, we'll talk about what is strategy trading. We'll talk about how to generate ideas, seeing patterns in data, how to begin by defining your rules, then adjusting your rules with back testing, finalizing your rules with forward testing, adjusting rules from large sets of data, and then finally putting the strategy into practice. We will look at some of the challenges in developing a trading strategy. I'll give you a few ideas to consider for your own trading strategies. We'll talk about my trading strategies, which is the Stockscores Trader Training option, and then the Active Live service, which is available for my day trader students, where I will show you my screen during the day as my algorithms run, identifying entry signals on my daily watch list of stocks. All right, so we've got quite a bit to go through. We'll probably go through this fairly quickly. However, I am recording tonight's presentation, so if it feels like it's a little too fast, you just know that you can go back and watch the video later and catch up on anything that you may have missed. All right, so let's begin with the first topic. What is strategy trading? It's basically trading on a set of rules that are based on logic. So buy when A, B, and C are met, sell when D, E, and F are met. Very strict logic, no human judgment. Now, the rules do require the human element. That's where you're doing your testing. And you test those rules over a large sample size. Now, if you were to come up with a set of rules and only test it on, say, the last 10 trades, you might get a very different answer than if you took a set of rules and tested it over 1,000 trades. It's kind of like if you went to Vegas and were playing blackjack, you might say that if you hit every time there's a red card on the table, and just by the fluke of low numbers you make money 5 out of 5 times, it doesn't mean that hitting every time there's a red card on the table is going to work. Obviously, if you tested that over a large sample size, like 1,000 hands of blackjack, you're going to get a very different answer than you might get on 5 hands of blackjack. It's possible to toss 5 heads in a row if you were tossing a coin, but to toss 500 heads in a row out of 500 is virtually impossible. And so when we test rules over a large sample size, we get very good insight into the probability of something happening. So this is also called algorithmic trading. It is currently a growing area of trading. The most successful hedge funds in the world, the highest paid fund managers in the world today are employing algorithmic trading. Companies like Renaissance, Citadel Capital, I think it's called Citadel Capital. Anyway, Citadel. These are huge hedge funds that are primarily computers trading the market. You may have heard that roughly 50% of trading on the New York Stock Exchange is driven by a computer. It's not even humans doing it anymore. So we as individual traders can take the same approach. We use algorithms to pick our entry and exit points. We may execute them manually because the kind of strategies that I do are not so time sensitive that you can't do it as a human being. But ultimately, the entry decision, the exit decision is based on the computer algorithm. We can automate much of the process. Probably 95% of what I do is now automated in terms of the entry signals being alerted to by a computer. And the nice thing about this is that if you do it properly, you can be very profitable consistently. What is key when you are developing a strategy is that you avoid bias. it's very easy to take a biased approach to trading. So let me just show you an example of an algorithmic trade. You'll see here on this chart, and I'll zoom in on this a little bit because it's very tiny, but you can see that there's little pink dots on this chart. So this is something called an action candle. And an algorithmic strategy might say, if there is an action candle breaking through a trend line of resistance after the stock has been trading sideways for 4 days, buy. So that occurred, here, for example, there was a pink dot and the stock had been in a sideways pattern for 4 days. You might even consider this one where it's breaking through this trend line and having gone sideways for 6 or 7 days in a row. I'm not applying any fundamental analysis of this company, which is Advanced Micro Devices. I might know nothing about the company. All I know is that the people who are buying the stock aggressively, which painted the picture for me, and I've built an algorithm to put a little pink dot on the chart when something unique happens. Well, that gives me some insight into what's going on with this particular stock. I don't need to know anything more than that because I trust that the people who follow this company the closest are going to act aggressively in the market when something is happening, and my algorithm will pick up on that. That's what this particular algorithm is designed to do, to look for statistically significant abnormal price and volume behavior. And we've talked about that many times. That's the core of many of my strategies. So I bought 5,000 shares of AMD 2 days ago. Today, right at the end of the day, it made a huge jump. In the aftermarket, it's over 14, I think over 1460. Can't remember. Oh, here I've got the chart open on the intraday. I'll show you what it did today. I bring this one up because it made me very happy. So yeah, it closed at 1462 in the aftermarket. It jumped up to 14 or just under $14 during regular trading, and then went even higher in the aftermarket session. And again, I don't know anything about AMD. Apparently, they announced, or word got out, that they are partnering with Tesla on the development of artificial intelligence chips for the cars. And their stock made a huge jump, and I'm currently up over $10,000 on that trade in 2 days. So that's algorithmic trading. Now, where do you get the idea from? So I'll tell you a little story about how I started trading 27 years ago. Well, this is going to go back, say, 24, 25 years ago, which is when I first started doing this. My whole theory was, let's reverse engineer the stock market. I started by looking at the stocks I wish I had bought, the stocks that had gone up a lot. Now, this is very early in the internet age. I used to look at charts in books. I used to actually manually draw out charts by myself. But what I started by doing is looking at the newspaper for example, the Financial Post, which was the precursor to the National Post in Canada, and another newspaper, the Globe and Mail. They would put out lists on a weekly basis of the best performing stocks for the week, for the month, for the year, that sort of thing. And that's what I started with. I looked at the best performing stocks of the week, the month, the year, and I drew out their charts, and I looked for signs that those stocks were going to do well. I looked at lots and lots and lots of top performing stocks and tried to work backward, looking for those signals that happen early. And I spent countless hours. I mean, today you can do this with the powerful software that I use, but back 25 years ago, we didn't have that kind of software. In fact, we didn't even have great charts. I would either draw the charts out by hand, or I used a very expensive service where I would download the data for one chart at a time, and it would take probably 30 seconds per chart to download the data, and then I would have to import it into some software so I could chart that stock. What I'm trying to show you is that it was a lot of work back then. Nowadays, this is much easier. So I would print out the charts, I would put them in a binder, and I would just flip through them and look for common things that happened early in the upward trend. And what I found was that most stocks that do well, that beat the market, do so with abnormal price and volume behavior early in the trend. So when I was showing you advanced micro devices on the 13-minute interval here, that's what that is. That's looking for abnormal price and volume behavior. Now, this particular indicator that I'm using today is not something I had 25 years ago. This software didn't exist 25 years ago. So nowadays, it's way easier to do what I was doing 25 years ago when I was figuring all this stuff out. Now, eventually, I realized that I needed some automation, some tools. And so I created in the year 2000 the Stockscores website, and a core component of that website was the Stockscores market scan. And that tool allowed me to filter through the entire market in seconds looking for different criteria. And I'll show you that market scan. I'll show it to you right now. So let's jump over to the Stockscores website, go to the market scan tool. Now, what you're seeing here is a few generations on. Obviously, when we built this in 2000, it was probably simpler, although not a whole lot different. So for example, I could say with this tool, show me all the stocks on the Canadian exchange that had an abnormal day to the upside and traded abnormal volume and traded at least 100 times today. Run the scan. And it almost instantly gave me a list of 9 stocks that meet that criteria. And I can then view those charts if I want in a slideshow, go like this. And I can just cycle through these charts looking for the patterns that I've learned to look for. So for example, this DYA on the venture market is breaking a downward trend line. That has a pretty good potential to go up to $1.05. The reward for risk of this particular entry is not outstanding, so I'd rate this one a 6 out of 10. But what I do is I go through these as I'm looking for certain patterns that I have developed an eye for over the years. BlackBerry looks very good. I'd give this one a 7 out of 10. You can see very strong volume today, strong price action. There's, I would say, a 65 to 70% chance that this stock, BlackBerry, will move up into the $15 range in the weeks, maybe over a couple of months. And so it's a kind of thing that I'm looking for. All right, so that is how we use Stockscores to do algorithmic trading. I've programmed in the algorithms into the Stockscores website, and it's just a matter of looking for the pattern. For example, Air Canada met my rules right there on that day. You can see the abnormal volume, the abnormal price movement. That was when the stock was at $14. Now it's at $26. It's nearly doubled in the last 4 months. Now, I also use some software called TradeStation. TradeStation has nothing to do with me. That is a third-party software that I subscribe to. It's something I've been using. For probably 15 years. TradeStation is this program here that I was showing you earlier. And I have programmed my own indicators into TradeStation. Those indicators are very similar to what you get on in Stockscores. The math is very similar. But the nice thing about TradeStation is I can apply those rules to the intraday chart as well. So I can look at the 2-minute chart, the 13-minute chart, all these different intervals, looking for my action candles on those intervals. Okay, I'm just going to pause for a moment here. Hold on a second. Okay, so moving on, and I have, when I'm using TradeStation, I have a process that I'm going through as I do my list building and that sort of thing. So I have a step-by-step process that uses these windows here to build my watch list of stocks that I'm considering, whether it's as position trades, which are long-term trades, or as day trades, or as swing trades. It's all used in this tool. All right, so moving on to where we were, this TradeStation scanning. What are the common characteristics of winners? That's what we're trying to do. And it could be short sells, it could be buys. We're looking for situations where there's abnormal price, abnormal volume. For example, that's what I was looking for. I was looking for breaks of resistance. And what I begin to do is to build a spreadsheet to track potential filters. So I might say, okay, let's look at all the examples over the last month where the stock made an abnormal price jump with abnormal volume, breaking through resistance. And I'll track that in a spreadsheet. So I'll show you what one of those spreadsheets looks like. This is the spreadsheet I've developed for one of my day trading strategies. And I've got all these different indicators here. So here is the watch list from today, September 20th. And you can see I've got percentage change from the open, number of trades, some different statistical measures that I track, the abnormality of it on an entry signal, the max gain, the max loss. I track all that stuff. I track different pattern breaks. And from that, I create a database. And you can see that this database has over almost 4,000 records in it. And this just goes back to the start of May, I believe. And so, and then I started tracking the performance of the rules using different criteria, this being since the start of August. So since the start of August, using these parameters, which I can change, I've got a net gain of $115,000 on 293 trades with an average profit per trade of $395. Today, my strategy made a profit of $5,800 on 7 trades for an average profit per trade of $828. Now, because I've collected all this data, I can start to do what-if analysis. I can say, well, what if I raise my AV, which is one of my indicators, to a 3 instead of a 2? What happens to my profitability? Well, now I made $5,400 on 6 trades for an average of $915 per trade. All right, so we can start to do what-if analysis with spreadsheets like this to develop a set of rules. That's what we're trying to do here, is build a set of rules, test them, and experiment with how we can change the rules. Now, the most time-consuming part of this is collecting data. All right, I've been doing this every day for a few years, probably, and it takes a considerable amount of time. I'm very fast at it now. I can do the work each day in about 30 to 45 minutes, but every day for 30 to 45 minutes, I'm collecting data on that day trading strategy, on another day trading strategy that I'm working on a new position trading strategy that I'm working on. I'm always trying to come up with new strategies, new rules for when to buy, when to sell, and how to manage risk. And that's important. It's not just about the entry decision. We have to consider the risk of the trade and risk management and when we're going to exit those positions. Now, once I've done that, once I've come up with what I call my positive rules, so these are the rules for when I'm going to buy, what I then do is I start to look at trades where it failed. So I'll go back into my spreadsheet and I'll look for losers. So for example, this stock today, which was on DMPI, was a loser. It lost $2,100. So I'm going to look for what are the characteristics of the losers that aren't characteristics of the winners to try to add a few more rules that will eliminate some of the losers but still capture the winners. And this is that ongoing process of defining rules. So I call those the negative rules, the rules that I want to use to avoid losers as opposed to focusing in on the purchases. Now, we don't want to, it's not our goal to eliminate every loser. It's not our goal to find every winner. That's impossible. What we're trying to do is what will make us the most amount of money over a large sample size. So going back to my spreadsheet, if I sit here and experiment, now watch these numbers right here. That's for since the start of August. So what is that, 7 weeks now? If I go 1, my profit was $120,000. If I go 2, my profit was $115,000. If I go 3, my profit was $105,000. And so I can experiment with different values to try to maximize the profitability overall, but also the average profitability. Notice that when I do 3, my overall profitability was $105,000, but my average was $509,000. Now watch what happens when I drop this to 1. If I make it 1, my total profitability jumps to $120,000, but my average drops to $302,000. So in other words, I do a lot more trades to make more money, but my average profit per trade is less. And that's a critical question because if you have limited amounts of capital, you can't maybe do 400 trades in 7 weeks because it takes too much money. If I make this a 3, well, now my trades are cut in half, and yet my profitability didn't go down that much. It went from 120 to 105, but basically on half the number of trades. So we're always trying to think about how can we maximize not only our overall profitability, but our average profitability per trade. Now, once I have developed my rules, I then start to test them with forward testing. This is trading without the benefit of hindsight. You know, when we're back testing, there's a bias there. We can bend our rules a little bit. We may not mean to, but the reality of being a human being is we're going to see what we want to see. And so it's important to then go through the process of forward testing to define our rules going forward without the benefit of hindsight. So I'm actually going to do paper trading or simulated trading with my rules to see how well they do. We're going to test them in real market conditions without the benefit of hindsight. Now, I'm doing this on an ongoing basis. So, for example, I will use my other website, which is tradescores.com, to test in a simulated environment. So this here is what the trade tracker looks like. And if I wanted to do a simulated trade, I would click on Make Your Trade. I would enter in the symbol, where I'm going to buy it, where the stop loss is going to be, that sort of thing. And then this website will then track the performance over time. This is a free tool available at tradescores.com. And it's a great way to just test an idea. And then I can track my performance. So here I can see the hold period, 3 days, performance 57%, RR 2.47, and you can see there's some losers, some winners, and I'm trying to maximize the overall return through a testing process. And as you do that, you can then adjust your rules from large data sets. The more data you collect, the more valid the information you get from that data is. So I want to collect thousands of trades in a sample so that I can best define the rules that work across different market conditions, whether it's long or short, what time of the year it is, those sorts of things. Ultimately, what I'm trying to do is come up with an expected value for the trade. So if we go back to my spreadsheet, my average with slippage is $562. That is an expected value based on 13 trades. However, here I have an expected value of 509 based on 206 trades. So that's a larger sample set, and therefore it is a more valid estimation of expected value, what I would expect to make if I did these rules over the next 100 trades. We want to know total profit, average profit, and it's very important that we account for slippage. When you move in and out of positions, you're going to suffer, you're going to pay commissions, number one, but you're not always going to get paid or get in and out at the ideal price that the computer says you would have. That's the reality of the market. And that's why you see the difference here between gain-loss and gain-loss with slippage. There's a $20,000 difference there, basically a certain amount of percentage based on the number of trades that I've done so that I can be realistic in my valuation. You know, if you have a strategy that makes just a little bit of money every trade, it might not make money in actual practice because of slippage. Now then we're going to put the strategy into practice. This is where we're testing with real money. Our number one goal is capital preservation. We're going to start with $0 of risk, and we're going to scale up our risk with success and confidence in the rules. So I might start testing it on Tradescores in the simulator, and then over time I might go from $0 of risk in a simulator to trading it with real money, maybe risking $100 per trade. And let's say I make $1,000 at that level, then I will increase my risk to $200 per trade. Make another $2,000, now I'm going to increase my risk to $300. And you get the idea. I'm slowly increasing my risk tolerance as I find success and as I build my confidence that the rules are working as well as they did when I was testing them. Now again, it's important to consider how much capital you have, what your risk tolerance is. You know, if you don't sleep well risking $1,000 a trade, then you shouldn't be risking $1,000 a trade, even if you have $5 million. Okay, so it's about how much capital you have, but also what your tolerance for risk is. Now, what are some of the challenges in doing this? Well, let me tell you that data collection is extremely time-consuming and tedious. I spend, as I said, 30 to 45 minutes a day, and when I started doing it, it was probably more like an hour and a half to 2 hours, but I've built quite a system of doing it now where I can do it quite quickly. It's very difficult to avoid bias. We as human beings will introduce some of our biases into the process that limits the effectiveness of the strategy when we try it with real money. So we have to be aware that there's always going to be some bias no matter how hard we try not to have that. Building these data collection systems and doing the testing does require some computer skills. I would say you have to know how to use things like Excel. There are websites out there that will give you the ability to develop and test strategies. Quantopia and QuantConnect, they require a fair amount of computer skill, some programming in languages like Python. I don't use those myself. I just use Excel and TradeStation. It's also challenging not to what's called over-optimize your strategies. In other words, introducing so many rules that historically your strategy made lots of money, but because you over-optimized it, it actually doesn't work in real life. And that's a very real problem for people developing strategies. So what are some trading ideas to consider? Well, I've talked a little bit tonight about using abnormal activity to develop a set of rules, and most of my trading strategies revolve around that. Another popular algorithmic strategy is something called mean reversion. What that means is that if a stock makes a big jump up during the day or even during the week, some people will short that expecting that it will fall back to its average. Or if it drops a lot, it will move up as it comes back to the average trend for the stock. And that's a very common strategy for some of these big algorithmic trading firms that are based in New York and Hong Kong, London, that sort of thing. You can develop news and event-driven strategies. So in other words, looking for news releases as they come out and develop a set of rules around those. It's not something I do, but there are people that do that. If you like to trade biotech stocks, you may have heard of the PDUFA date, which is the date when the FDA announces its decision on whether a drug is being approved or not at a certain level. And these PDUFA dates are very important because stocks will tend to run up in anticipation of those dates. So you can develop a strategy around that. And that's very popular among people that trade the biotech stocks. Top down, looking at the strong sectors, and then looking for stocks within those sectors. And then another common algorithmic approach is hedged pairs trading. What that means is, say you want to do a hedged pair on banking stocks, you pick the strongest bank stock, let's say it's JP Morgan, and then you pick the weakest banking stock, let's say it's, Goldman Sachs, and you'll buy the strongest one and you'll short the weakest one. That way, if the index goes down, hopefully you make more on the short than you lose on the long. Or if the index of banking stocks goes up, hopefully you make more on the strong banking stock than you lose shorting the weak one. And that's really what hedge funds are all about. Nowadays, hedge funds the term is often used loosely, not to use that. But that was the original intent of hedge funds, is to do this sort of pairs trading where they look for correlated assets and buy one and short the other. So one of the great challenges for individuals is just having the time to do strategy development and maybe the expertise to do it. So I will teach you my strategies if you have an interest in that. I spend thousands of hours, tens of thousands of dollars developing the software and the algorithms and that sort of thing. And you can sort of save yourself all that brain damage and just use my strategies. So about 15 years ago, I guess, no, maybe not 14 years ago, shortly after I developed Stockscores, I began teaching people my strategies. And we have developed online courses, online education to teach you how to do what I do. So if we go into the Stockscores website again and go into Trader Training and Education Center, what you'll see here is the online Stockscores Education Center, where you can see all the different lessons. So in the foundation area, there is a lesson, for example, the 6 elements of chart patterns. You can read what those are, what they're all about. You can then watch a video from your computer, from your smartphone, from your iPad, whatever. And this little video will play here. Hopefully you can hear what's happening. And there's an assignment. So there's an assignment so you can develop your skill. And then finally, there is a quiz or a test to see if you understood the concepts of that particular module. So that's how the foundation area of the Education Center works. Then you have the knowledge, once you've done the foundation, you have the background knowledge to understand my strategies for investing, for active trading. I've got some new ones coming soon. But here I'm going to teach you the actual rules for when to buy, when to sell, how to manage risk. And for each strategy, there is a lesson written and a video explaining that particular topic. If you have some interest in that, go back to the Trader Training menu, go to the Learn How to Trade area, and there's a number of videos in here that describe each of the Stockscores courses. So there'll be a video, there'll be a written description, and then you can order the course right online from this area. Now, as a little bit of a bonus, coming up in November, I will be doing some bonus live training. So anyone that purchases any of these courses between the last time I did a course, so that was in June of this year. So anyone who's purchased since the last course, June, until now, or until the training starts in November, will get that live training included. I also have a mentorship program where I will teach you for 16 weeks. We have a weekly class, online class, much like this class tonight, where for 1 hour I teach a small number of people in a webinar the different concepts and topics, primarily focused on the active trading area because that's an area that requires more expertise. And we just go through 16 weeks in a row for about an hour each week with a live lesson, very hands-on training, and that mentorship will be starting in November. So one other thing I want to just outline before I answer your questions is the Stockscores Active Live. For those of you that want to learn how to day trade, if you have taken my Active Trader course, or if you plan to take my Active Trader course, once you've done that, you are eligible for Stockscores Active Live. In the first hour of the trading day, I build my watch list of stocks, and then my algorithms monitor those stocks for entry signals. We do some Stockscores market scans together. We track our performance each day. Basically, I show you that spreadsheet that I was showing you earlier. So we'll go through and review the trades of the day. So today there was 6 trades, and the best winner was $4,900. The biggest loser was minus $2,100. And overall, it was up $5,490. By the way, this is for a $1,000 risk limit. If I change that $1,000 to $100 of risk, then you see it ratchets down the profitability overall. All right. That service is available to active trader students. It's $195 a month. Basically, it's me doing all the work for you. You just have to execute the trades that you want to execute on based on my algorithm. So I'll just show you how it works. This is a little video that I'm just going to play of the active live running. And here you can see my current open positions. This is a video that I recorded during a trading day. The total profitability here for $100 of risk is $1,700. That was a good day. And then you hear the alerts. So I don't know if you heard that, but in a moment you're going to hear the word strategy alert. Strategy alert. Hopefully you heard that. And that was what you would hear if you were monitoring my webinar. So I build the list. I set it all up. We discuss a little bit of the markets for the first hour. And then for the rest of the trading day, the algorithm runs and it alerts you when there is a valid entry signal. All right, and that's something called Stockscores Active Live. If you do the Active Trader course, you are eligible to participate in that. So before I answer questions, I'm just going to leave you my contact information. My email address on screen, tylerb@stockscores.com. If you have any questions about the courses or topics that I went through tonight, you can email me there and I'll answer those as best I can. Make sure you follow me on Twitter. I put out some tidbits on Twitter. It's free, so follow me. Just search on Twitter for @Stockscores. I've also got a YouTube channel. I will be putting this video up on YouTube. I recommend that you subscribe to me on my YouTube channel at youtube.com/stockscores.com as you see it there, or you can simply search for Stockscores on YouTube. All right, well, I'm going to answer some questions and then we will wrap it up for this evening.